Hello and welcome. Today, we are going to explore a topic that is fundamental to understanding how companies report profit and make internal decisions: variable versus absorption costing. We'll see how these two different methods can lead to a tale of two very different incomes. Our journey today will start with a core difference between variable and absorption costing. We will then introduce our case study, Weber Light Aircraft, to see these concepts in practice. We'll build the income statement first using method 1, variable costing, and then using method 2, absorption costing. This will lead us to the central conflict: why do these methods produce different results? We'll then reconcile that difference by tracking fixed overhead costs. Finally, and most importantly for you as future managers, we will discuss the strategic impact of this choice on CVP analysis and internal decision-making. The entire distinction between variable and absorption costing boils down to one single question: is fixed manufacturing overhead a product cost that stays with the inventory, or is it a period cost that gets expensed right away? Let's look at them side by side. Variable costing treats only variable manufacturing costs as product costs. It considers fixed manufacturing overhead to be a period cost, which means it is expensed immediately in the period it's incurred. This method is primarily used for internal decision-making. On the other hand, absorption costing treats all manufacturing costs, both variable and fixed, as product costs. Under this method, fixed manufacturing overhead is attached to the units produced and is held in inventory until those units are sold. Absorption costing is required for external financial reporting. This flowchart provides a powerful visual of that core difference. Notice the path that fixed manufacturing overhead takes. Under absorption costing, the fixed manufacturing overhead costs join the other manufacturing costs and flow into the balance sheet, first as work-in-process inventory, then as finished goods inventory. Only when the goods are sold do these costs move to the income statement as part of cost of goods sold. Contrast that with variable costing. Here, the fixed manufacturing overhead completely bypasses the balance sheet inventory accounts and flows directly to the income statement as a period expense in the period it was incurred. To see how this works in practice, we'll analyze 3 months of operations for a company called Weber Light Aircraft. There are a few key data points to keep in mind as we go through the example. First, notice the relationship between production and sales. The number of units produced each month does not always equal the number of units sold. In January, they produce 1 and sell 1. In February, they produce 2, but only sell 1. And in March, they produce 1, but sell 5, presumably by drawing from inventory. Second, remember that fixed manufacturing overhead is a constant $70,000 each month. Let's start with method 1, variable costing. This method focuses on the contribution margin. A key feature here is that the unit product cost is constant, because it only includes variable manufacturing costs. For Weber Light Aircraft, this is $25,000 per unit. If you look at the income statement, you'll see it uses the contribution format, which separates variable and fixed costs. The key observation here is for January and February. In both months, sales were identical at $100,000, and as a result, the net operating loss was also identical at negative $25,000. This is logical and what most of us would intuitively expect. Now, let's switch to method 2, absorption costing. This method focuses on gross margin. Here's where it gets interesting. Under absorption costing, the unit product cost actually changes every month. This is because that constant $70,000 of fixed manufacturing overhead is spread across a different number of units produced each month. In January, the unit cost is $95,000. In February, When production doubles, the cost per unit drops to $60,000. In March, it's $42,500. Now, look at the income statement. This brings us to a puzzle. Sales were identical in January and February at $100,000. Yet, the net operating income swung dramatically from a $25,000 loss in January to a $10,000 profit in February. How is this possible? The answer to that puzzle lies in how fixed manufacturing overhead is either deferred in or released from inventory on the balance sheet. Let's take February, when production was greater than sales. Because Weber produced more units than it sold, some of that month's fixed manufacturing overhead got attached to the unsold units. That cost is deferred in the inventory account on the balance sheet instead of being expensed on the income statement. This is what makes the profit appear higher. Now consider March, when sales were greater than production. To meet sales demand, Weber had to pull units from its beginning inventory. When it did this, the old fixed overhead costs that were attached to those units were finally released from inventory and hit the income statement as part of the cost of goods sold. This makes the profit for that period appear lower. We can always connect the net incomes from these two methods using a simple reconciliation formula. The formula is absorption income equals variable income plus any fixed manufacturing overhead that was deferred, or minus any that was released from inventory. Let's look at the Weber light aircraft reconciliation. In February, the variable income was a loss of $25,000. We add the $35,000 of fixed MOH that was deferred in inventory, and we arrive exactly at the absorption income of $10,000. In March, the variable income was $235,000. We subtract the $35,000 of fixed MOH that was released from inventory, and we reconcile to the absorption income of $200,000. This brings us to the crucial strategic question. Which method should a manager use for decision making? Let's say management wants to use CVP analysis to find the sales needed to achieve a target profit of $235,000. If we use variable costing, the calculation is straightforward because it uses a stable contribution margin. The formula shows that we need $500,000 in sales to hit our target, and a quick look at the March variable costing statement confirms this works perfectly. Now, consider the problem with absorption costing. Under this method, net income is affected by both sales levels and production levels. This means a manager could potentially increase the company's profit under absorption costing simply by overproducing, even if those extra units are not sold. This can lead to very poor decisions and wasteful excess inventory. For this reason, CVP analysis is simply not reliable when used with absorption costing data. So let's conclude by summarizing how to choose the right tool for the job. The core difference, as we've seen, is the treatment of fixed manufacturing overhead. Variable costing treats it as a period cost, while absorption costing treats it as a product cost. This difference directly impacts reported income whenever production and sales are not equal. Remember the rules. When you produce more than you sell, absorption income will be higher. When you sell more than you produce, absorption income will be lower. For external reporting under GAAP, you are required to use absorption costing. However, for all important internal decision-making, such as CVP analysis and performance evaluation, variable costing is the superior method. It provides a much clearer picture of profitability that is directly tied to sales and avoids the distortions that can arise from changing production levels.